Imagine looking at a company that has about $82 million in the bank, absolute zero debt, and is simultaneously paying its former CEO over $5 million in cash just to walk away.
Right, just to leave.
Exactly, just to leave. And all of this is happening because its core business model is basically vanishing overnight. So welcome to the Deep Dive. Today we're taking you inside a real-time case study in corporate reinvention.
It's a really fascinating one, too.
It really is. We have a stack of financial documents in front of us today. We've got the Q3 2026 earnings report, the 10Q SEC filing, and the latest earnings call transcript for Resources Connection, Inc.
Which most people probably know as RGP.
Right, RGP, the massive global professional services and consulting firm.
And, behind the dense financial jargon in these filings, there really lies the story of a company trying to disrupt itself before the market does it for them.
Yeah, beat them to the punch.
Exactly. We are looking at how a major talent firm navigates a massive technological pivot, a completely shifting macroeconomic environment, and a total C-suite overhaul. And all of this is happening simultaneously.
Okay, let's unpack this.
Yeah.
Because to understand the sheer scale of this pivot, we have to start with the hard numbers. Yep. And frankly, the Q3 realities for RGP are tough to sugarcoat.
Yeah, they are pretty stark.
Very stark. We are looking at a total quarterly revenue of $107.9 million. That represents a 19.6% year-over-year drop when you adjust for same-day constant currency.
And we should probably clarify that term for a second.
Yeah, go ahead, because we see constant currency thrown around in earnings reports a lot.
Right. So basically, that metric strips out the noise of fluctuating global exchange rates.
So it's not skewed by the dollar.
Exactly. If the U.S. dollar suddenly gets super strong against the euro, it doesn't artificially make their European sales look terrible. It shows the true operational performance of the business day to day.
And even with that stripped away, I mean, almost 20% of their revenue just evaporated compared to last year.
Yeah, and it's not just the revenue. They also missed their expected revenue targets entirely, and they missed their earnings per share, or EPS.
Right. The EPS came in at -9 cents
Yeah.
against an expected -5 cents, which is a big miss.
It's huge, because for anyone who doesn't obsess over stock markets, earnings per share is the ultimate scorecard for investors.
It's the bottom line.
It really is. It takes the company's total profit, or in this case, their loss, and divides it by the number of individual shares out there. It tells you exactly how much money each share is actually generating.
So when a company misses that expectation by nearly double, the alarm bells start ringing loud.
Oh, absolutely. A near 20% revenue drop means fewer billable hours are being worked across the board. Client projects are getting delayed or canceled, and the overall pipeline of future work is just visibly contracting.
And looking ahead, I mean, their Q4 guidance is extremely cautious. They project somewhere between $104 million and $109 million in revenue.
Which means they're tracking to perform even lower than Q3.
Exactly, the bleeding hasn't stopped. But here is the paradox. Looking at these numbers, it kind of reminds me of losing your job, but walking home to a massive, completely untouched emergency fund sitting in a high-yield savings account.
That's actually a great way to put it.
Right. Because while the income statement is taking a massive beating, the balance sheet tells a radically different story.
It's like two different companies.
Seriously. RGP finished the quarter with $82.8 million in cash. They have zero debt. And they have $79 million in buyback capacity.
And that buyback capacity is a massive safety net.
Yeah, it means they have board approval to buy their own stock back from the public market if the price drops too low.
Which artificially supports the stock price and signals to investors, hey, we still have cash and we still believe in our own value.
But so here's my pushback for you on that. If Q4 is already tracking lower than Q3, isn't this cash fortress just delaying the inevitable?
That's a fair question.
I mean, at what point does a financial safety net become nothing more than a comfortable waiting room for a slow decline?
What's fascinating here is the crucial distinction between a liquidity crisis and an operational pivot.
Okay, say more about that.
Well, if RGP had massive debt and dwindling cash alongside that sharp revenue drop, they would be in absolute survival mode.
Right, the panic button.
Exactly. Management would be making panicked, reactive decisions. We'd see them slashing their hourly consulting rates just to win any contract they could find.
Or taking on terrible clients.
Or firing their core essential talent just to make payroll. But
Huh.
because of the balance sheet you just described, they aren't backed into a corner.
They can afford to take a hit without the whole company going under.
Precisely. And this offers a really powerful lesson for you as a listener, honestly, regardless of your industry.
How so?
When you face a downturn in your own career or business, having a strong balance sheet, whether that is literal financial savings in the bank or a deeply valuable, undeniable core skill set, that is what allows you to pivot deliberately.
It keeps you from making decisions out of pure desperation.
Right. RGP's cash fortress is not a waiting room for a decline. It is the funding mechanism for their transformation. It gives them the breathing room to absorb the shock of shrinking legacy revenue.
While actively making reasoned investments in their next chapter, right? Without having to go beg a bank for a high-interest lifeline.
Exactly.
Well, let's look at what is actually causing that shock to their legacy revenue. Because the narrative in these documents clearly shifts from what the numbers are to the underlying mechanism driving the drop.
Yeah, the root cause.
The causal link here is a massive decline in billable hours, specifically inside their on-demand talent segment. Revenue in that one area plummeted to $40.9 million.
And the direct driver of that. AI and automation are actively replacing traditional operational accounting roles.
Wow. Think about the manual tasks humans use to bill $50 to $100 an hour for. Data entry, basic ledger reconciliations, standard end-of-month reporting.
The machines are doing it faster, they're doing it cheaper, and with fewer errors.
And we aren't talking about like a 5-year projection of what AI might do to the labor market.
No, this is happening today. It's quantified in this specific quarter's earnings report. Clients are actively deploying off-the-shelf AI tools to handle their books.
They simply do not need to hire fleets of on-demand operational accountants from firms like RGP to augment their staff during tax season.
Or during a big audit, the volume of low-level manual work is permanently shrinking.
Here's where it gets really interesting. RGP is a firm that consults on tech and finance. They literally help companies modernize their accounting systems.
Yeah, that's their core business.
So if their bread and butter operational finance roles are being automated by the very technology they help implement, aren't they basically selling the rope that will hang their own revenue model?
It totally seems that way.
I mean, they are actively helping clients install the AI that eliminates the need for RGP's own core talent.
It looks entirely contradictory on the surface, but, this is the textbook definition of trying to turn a headwind into a tailwind.
Okay, how so?
Well, RGP recognizes a fundamental truth about technological disruption. If they don't help their clients implement AI, another consulting firm will step in and do it anyway.
So it's inevitable.
The automation of those operational accounting roles is a guaranteed outcome. So rather than fighting a losing battle or pretending this shift isn't happening, RGP is making an aggressive, forward-looking counter move.
Like bringing in Jessica Block as their new Chief Artificial Intelligence Officer?
Yes, and Prashant Lamba as their new Chief Information Officer.
Which are entirely new roles, right?
Yeah.
Designed to change the very nature of what RGP sells.
Exactly. They are pivoting away from providing the people who do the manual work and moving toward providing the specialized experts who figure out how the AI works in the first place.
So let's break down the mechanics of what that new work actually looks like. Because an AI doesn't just magically understand a company's financial history.
Oh, definitely not. You have to feed it clean, organized data.
And RGP wants to be the firm that comes in, untangles a client's messy, unstructured historical data, and structures it so a large language model can actually read it.
Right. They want to be the advisors sitting at the table helping a chief financial officer decide whether they should buy a prepackaged AI accounting tool from a vendor or build a custom proprietary system in-house.
That is highly specialized, high-margin strategic consulting. In fact, CEO Roger Carlyle specifically stated in the earnings call that AI is a tailwind for those who don't just sit by and do nothing.
Because if you offer data entry clerks in 2026, your business is obsolete.
Yeah, completely dead.
But if you offer the data architects who build the automated entry systems, you are indispensable.
But to make that kind of monumental shift, you need the right people driving the ship. You cannot execute a massive technological pivot using the exact same legacy leadership structure that spent the last decade optimizing the old model.
No, you really can't. Legacy leaders often struggle with these transitions because their entire mental model of success is tied to the previous era.
They know how to squeeze a 5% margin increase out of human labor.
Exactly. But they might not understand the unit economics of AI deployment. That is why the structural changes happening in RGP's C-suite are so drastic.
And why they are incredibly expensive. Let's talk about the sheer cost of changing the guard, because the numbers here are staggering.
They really are eye-watering.
Former CEO Kate Duchesne stepped down in November 2025. Her exit package includes a $5.3 million cash severance.
$5.3 million.
Cash. That is 3 times her base salary and target bonus. And on top of that, she gets a prorated bonus of over $554,000, healthcare coverage, accelerated vesting of all her unvested stock awards, and get this, a $12,500 per month consulting fee that pays out every month through the end of 2028.
It's a massive payout.
And then you have their chief operating officer, Bhadresh Kumar Patel, who is leaving in May 2026 with a $1.65 million severance of his own.
So they're paying a huge premium just to clear the deck.
Right. I look at this and I think about breaking a highly expensive commercial lease.
Oh, that's an interesting comparison.
Imagine you run a retail store, but the neighborhood around you is dying. Breaking your 10-year lease to move is going to cost you a small fortune in penalties today.
Oh, you do it anyway.
You do it because moving to a thriving location is the only mathematical way your store survives the decade. It drains your bank account right now, but staying put is fatal.
That commercial lease analogy hits the exact financial logic at play here. You have to pay the exit toll to get access to the new highway.
Right.
But we must weigh this massive outflow of executive severance cash against the aggressive new cost-cutting realities RGP is implementing under the hood.
Okay, the Transformation Initiative.
Yes. They launched a program called the 2026 Transformation Initiative. This is a deep reshaping of their entire operational footprint.
They executed reductions in force in October 2025 and again in January 2026.
They're systematically trimming the middle management and administrative layers that were built to support the old, high-headcount business model.
And by cutting that infrastructure, they expect to yield $12 million to $14 million in annualized savings.
Exactly. So they bleed cash on severances this year, but permanently remove $14 million from their operating costs every single year going forward.
And the timeline for realizing that return on investment is the critical factor to watch here. CEO Roger Carlyle expressed confidence on the earnings call that they will return to revenue growth by fiscal 2027.
He outlined the specific mechanics of the consulting sales cycle, too.
Right, because you did not just hire a chief AI officer on Monday and sign $10 million in new AI consulting contracts by Friday.
No, it takes 6 to 9 months for these newly hired strategic leaders to ramp up. They have to integrate into the firm, build trust with enterprise clients, and actually start generating billed revenue.
The entire organization is being pruned to focus entirely on what Carlyle calls the intersection of the modern CFO and CIO.
Because finance and technology are no longer separate departments in a modern enterprise.
Not at all. The chief financial officer relies entirely on the tech stack managed by the chief information officer to understand the company's financial health.
RGP is paying the penalty today to ensure they are the premier consulting firm operating precisely where those two roles overlap.
But there is a final piece to this turnaround puzzle. Once you change the leadership and cut the internal administrative costs, you have to clean up your portfolio of services.
They really do.
If your entire future depends on dominating that CFO and CIO intersection, you cannot afford to manage side projects.
Which brings us to the disposition of a firm called Sitrick.
Right. So RGP signed a binding agreement to sell Sitrick, which is their crisis communications and public relations arm, back to its original founder, Michael Sitrick.
And the sale price is between $1.4 million and $2.3 million.
But here is the catch. RGP is keeping the office lease liabilities for Sitrick's physical spaces, and they are paying Michael Sitrick a $4 million severance equivalent.
Yeah, that part is a bit of a head-scratcher at first glance.
Here is my pushback. We live in an era of constant, unavoidable corporate crises. On this very earnings call, they cited geopolitical tensions like the Iran conflict as a macro factor causing market hesitation.
We have supply chain breakdowns, data breaches, constant PR disasters.
Exactly. So why on earth would you sell off a crisis PR firm right now, especially when you were taking on the lease liabilities and paying out millions just to get rid of it?
If we connect this to the bigger picture, it all traces back to a strategic business concept called the competitive right to win.
Okay, unpack that for me.
A crisis PR firm, especially a well-known entity like Sitrick, might generate profit on its own. But we have to look at how a PR firm actually integrates with implementing an enterprise resource planning software.
Or building a secure data lake for a chief financial officer to run AI models on.
They have zero overlap.
Huh.
They are entirely separate disciplines. When a company is fighting through a massive existential transformation, management attention becomes a finite and incredibly scarce resource.
That makes sense.
Every hour the CEO or the board of directors spends reviewing the quarterly performance of a PR firm or dealing with the unique operational headaches of a media business is an hour they are not spending on executing their core AI and digital finance strategy.
So Sitrick, in the context of RGP's future survival, is just a massive distraction.
Exactly.
I get the concept of focus, but paying $4 million in severance, plus keeping the commercial leases, just to get rid of a business that could potentially make money, that still sounds like terrible math.
I know it sounds counterintuitive.
How does management actually justify taking a multi-million-dollar bath just to stop looking at a subsidiary?
You have to measure the cost of distraction against the size of the total addressable market they are trying to capture.
The AI market.
Yes, the market for AI enterprise integration is worth hundreds of billions of dollars. If retaining Sitrick causes RGP's executive team to miss even one major enterprise AI contract because their attention was split managing a PR crisis, they have lost far more than $4 million.
Wow, when you put it like that.
Think about this in terms of your own life or career as a listener. Sometimes, to truly succeed in your primary objective, you have to divest from profitable side hustles.
Yeah, if you have a side project that makes a little bit of money, but it constantly drains your mental energy.
And prevents you from mastering your core profession, it is actively holding you back from larger success.
For RGP, focus is literally a financial asset. Taking the immediate loss on those leases and paying that severance is the mathematical cost of regaining total, uncompromised focus on the only mission that matters.
It's a bold move, but a necessary one.
We have covered incredible ground today. Let's pull all these threads together. RGP is a company choosing to endure severe short-term financial pain.
They are stomaching massive executive payouts.
Navigating the rapid, AI-driven erosion of their traditional on-demand accounting revenue and actively shedding functional parts of their business like Sitrick.
And they are doing all of this based on a massive, highly calculated bet
That a leaner structure, a fortress-like balance sheet, and a hyper-focused pivot toward artificial intelligence integration will slingshot them back to sustainable growth by 2027.
It is a high-stakes transition, but by utilizing their cash reserves rather than taking on debt, they are actively dictating the terms of their own evolution.
Rather than waiting for the future to render them obsolete.
Exactly.
So what does this all mean? When we look at everything RGP is building toward, we are left with a fascinating dilemma about the future of consulting itself.
Yes, and this raises an important question you should carry with you long after you finish listening today.
What's that?
RGP is fundamentally pivoting to help their clients become radically, ruthlessly efficient using AI. They are going to build automated systems that can do the work of 100 operational accountants in a fraction of the time.
Right.
But if RGP executes this strategy perfectly and makes their clients' finance and tech departments exponentially faster and leaner, doesn't that inherently shrink the total universe of billable consulting hours RGP can ever sell in the future?
Oh, well, yeah. If you are an AI consultant and you build a truly self-sustaining intelligent system for your client,
Is your ultimate success simply automating yourself out of a job?
that is a wild thought to end on. Thank you for joining us on this deep dive. As you tackle your own projects today, take a hard look at your own professional landscape.
Are you holding on to a profitable distraction that is splitting your focus?
Do you have the balance sheet to survive a necessary pivot? And perhaps most crucially, are you preparing to be the architect who builds the machines? Or are you waiting around for the machines to replace you? We will catch you on the next deep dive.